What are interest rates and how do they impact debt? Imagine borrowing money from a friend and paying them back a little extra for the favor. That extra is like interest, which is what lenders charge when you borrow money. When you get a loan or use a credit card, the lender charges interest as a fee for letting you use their money. Think of it as renting money. Just like renting an apartment, you pay rent to live there, but in this case, you pay interest to use someone else's cash. Interest rates are shown as a percentage of the amount you borrow, called the principal. For example, if you borrow $1,000 at a 5% interest rate, you will pay $50 per year for borrowing that money. The interest rate can stay the same over the loan period, called fixed, or it can change over time, called variable, depending on market conditions. Several things decide what interest rate you get. The Federal Reserve, which is the central bank of the United States, sets a main interest rate called the federal funds rate. This is the rate banks charge each other overnight. When the Fed raises this rate, banks usually increase the interest rates they charge you. When the Fed lowers it, borrowing becomes cheaper for everyone. Your personal credit score also plays a big role. If you have a high credit score, lenders see you as less risky, so they offer lower interest rates. If your credit score is low, they charge higher rates to cover the risk that you might not pay them back. The type of loan matters too. A mortgage, which is a loan to buy a house, usually has a lower interest rate because the house acts as collateral. A credit card, which is unsecured, often has higher rates. The length of the loan also affects the rate. Longer loans tend to have higher interest rates because they carry more risk for the lender. Inflation, or how much prices go up over time, also influences interest rates. When inflation is high, the Federal Reserve raises rates to slow down spending. When inflation is low, rates tend to be lower to encourage borrowing and spending. Most loans and credit cards use compound interest. This means you pay interest on the original amount borrowed and on the interest that has already accumulated. For example, if you borrow $1,000 at 5% interest compounded annually, in the first year you owe $50. The second year, interest is calculated on the new total of $1,050, which is $52.50. Over time, this can make your debt grow faster than you expect because the interest keeps adding up on previous interest. This is why credit card debt can become a big problem. High interest rates and compounding can make your debt grow quickly if you only make minimum payments. The more you owe, the more interest you pay, and it can take a long time to pay off. If you have a loan at a high interest rate, you will pay more money overall. For example, on a $10,000 loan at 5% interest, you might pay about $2,500 in interest over 5 years. But if the rate is 10%, you could pay over $5,000 in interest. That extra money adds up and makes your debt more expensive. Interest rates also affect your monthly payments. Lower rates mean smaller monthly payments, which can seem easier to handle. But if you borrow more because the payments are low, you might end up owing more money over time. When interest rates go up, especially on variable rate loans like some credit cards or adjustable rate mortgages, your monthly payments can increase. That's why fixed rate loans can be safer. They keep the same rate no matter what happens in the economy. If you don't pay your debt on time, interest keeps adding up daily on credit cards. This makes it even harder to pay off because your balance grows every day you don't pay. So, understanding how interest rates work helps you avoid bad debt. Always ask about the interest rate before borrowing. Is it fixed or variable? How much will I pay in total? Can I afford the monthly payments? Remember, even a small difference in interest rates can add up to a lot of extra money over time. Keeping your interest rates low by building good credit and paying off debt quickly can save you thousands of dollars in the long run.